Good evening, and welcome to Truth Report. I'm Alex Truth, and tonight we're following the money, from the labs of Chinese AI drug discovery to the boardrooms of America's most famous conglomerate. Two stories, two continents, one common thread: the future of corporate profit is being rewritten right now, and the question is whether anyone's paying attention to the risks.
I'm Maya Clarity, and Alex, these stories couldn't be more timely. On one side of the Pacific, a company most Americans have never heard of just crossed a profitability milestone that signals a seismic shift in how drugs get discovered and made. On the other side, the new CEO of Berkshire Hathaway, Warren Buffett's hand-picked successor, just published his first letter to shareholders, and what he left out may be more important than what he put in.
We're talking about billions of dollars in implied risk, breakthrough technology that could reshape the pharmaceutical supply chain, and corporate leadership that seems to be looking backward when the world is lurching forward. Buckle up, because we've got a lot to unpack.
Let's start in Shenzhen, China, with a company called XtalPi Holdings. And then we'll move to Omaha, Nebraska, where Greg Abel is stepping into shoes that may be impossible to fill, and may have already stumbled on his first big public test. Stay with us.
This is Truth Report. Let's get to work. Our first story tonight comes from the South China Morning Post, reporting out of Hong Kong. XtalPi Holdings, a Chinese artificial intelligence-powered drug research company, has announced it expects to turn its first-ever annual profit. We're talking about a projected net profit of at least 100 million yuan, that's roughly $14.5 million, for the year 2025. And that's a swing from a net loss of approximately 1.5 billion yuan in 2024.
Let those numbers sink in for a moment. This company went from losing 1.5 billion yuan, over $200 million, to projecting a profit of at least 100 million yuan in a single year. That's not incremental improvement. That's a complete financial reversal. And the engine behind it is a 193% jump in revenue. According to XtalPi's filing with the Hong Kong Stock Exchange, this growth was driven by their AI-powered drug discovery and solid-state research platforms.
Now, for anyone unfamiliar, XtalPi sits at the intersection of two of the most consequential industries of our time, artificial intelligence and pharmaceuticals. What they do, in simple terms, is use AI and computational physics to predict how drug molecules will behave. That includes crystal structure prediction, which is critical for determining how a drug is manufactured, how stable it is, and how effectively it can be delivered to patients. This is not trivial work. Crystal form can determine whether a drug makes it to market or dies in development.
And here's where the story gets strategically important. XtalPi isn't just a tech startup playing around with algorithms. They have deep partnerships with major global pharmaceutical companies. Their client list has included Pfizer and other multinational drug makers. The company uses what they call their ID4 platform, an intelligent digital drug discovery and development system that integrates quantum mechanics, AI, and cloud computing to simulate molecular behavior at a scale and speed that traditional lab work simply cannot match.
The Shenzhen-based company was founded in 2014 by MIT-trained researchers, and it went public in Hong Kong. It's backed by significant venture capital and strategic investment, including funding from SoftBank, Tencent, and Google's Gradient Ventures. So when we talk about this company reaching profitability, we're not talking about a scrappy garage operation. We're talking about a well-capitalized, globally connected enterprise that has now proven its business model can actually generate returns.
And that profitability milestone matters enormously for the broader AI and pharma sector. For years, critics have asked the same question about AI drug discovery companies: can you actually make money doing this? Companies like Recursion Pharmaceuticals, In Silico Medicine, and others have faced relentless scrutiny over burn rates and the gap between technological promise and commercial viability. XtalPi crossing into the black is a signal that the market will take very seriously.
But let's push deeper here, Maya, because this story isn't just about one company's earnings. It's about the geopolitical landscape of pharmaceutical innovation. China has been aggressively investing in biotech and AI-driven drug research as part of its broader strategy to move up the value chain, away from being the world's factory floor and toward being a global leader in high-value innovation. XtalPi's success is a proof point for that national strategy.
Exactly. And that creates a complicated dynamic for Western pharmaceutical companies and regulators. On one hand, AI-driven drug discovery promises to cut development timelines from over a decade to potentially just a few years. That means cheaper drugs, faster treatments for emerging diseases, and breakthroughs for conditions that have resisted traditional research methods. On the other hand, if the leading platforms for this technology are based in China, it raises questions about intellectual property, data security, and supply chain dependency that we've already seen play out in sectors like semiconductors and telecommunications.
The revenue breakdown is telling here too. XtalPi has been diversifying its income streams. They're not solely reliant on service contracts with Big Pharma. They've been developing their own proprietary drug candidates using their AI platform, which means they could eventually capture not just service fees but actual pharmaceutical revenue, royalties, licensing deals, and potentially direct sales. That's the difference between being a contractor and being a principal. It's the difference between building someone else's house and owning the real estate.
And the 193% revenue jump suggests their commercial traction accelerated dramatically. That kind of growth rate, if sustained even partially, puts XtalPi on a trajectory to become a major player not just in the AI services market but in the pharmaceutical industry itself. We should be watching their drug pipeline as closely as we watch their financial statements.
There's also a workforce and talent dimension to this. Companies like XtalPi are pulling from the same global talent pool as Google DeepMind, which made headlines with its AlphaFold protein structure predictions. The competition for researchers who can work at the intersection of AI, physics, and biology is intense and international. XtalPi's profitability means they can now fund at talent acquisition from operating revenue rather than burning through investor capital, which gives them a structural advantage in the hiring market.
So who wins and who loses in this story? The winners, in the near term, are XtalPi's investors and employees, obviously. But also potentially patients around the world who benefit from faster, cheaper drug development. The pharmaceutical companies that partner with XtalPi get access to capabilities that would cost them hundreds of millions to develop in-house. The losers, potentially, are Western AI drug discovery companies that are still struggling to prove profitability. And more broadly, any nation that falls behind in the AI biotech race risks ceding strategic leverage over its own healthcare system.
And let's not forget the broader power structure at play. The pharmaceutical industry has historically been dominated by American and European companies, your Pfizers, your Roches, your Novartises. If AI-driven drug discovery tilts the playing field, and if the most advanced platforms are Chinese, we could see a fundamental redistribution of power in one of the world's most profitable and consequential industries. That's not a prediction, that's a trajectory that's already underway, and XtalPi's profitability is the latest data point confirming it.
Moving now to our second story, and we're crossing the Pacific to Omaha, Nebraska. CleanTechnica is reporting on what is arguably the most closely watched corporate letter in American business, the annual Berkshire Hathaway shareholder letter. This year's letter is historic because it's the first one written not by Warren Buffett but by Greg Abel, the new CEO who formally took the reins from Buffett.
And Maya, this letter has drawn sharp criticism from climate and financial risk analysts for what it conspicuously fails to address. According to CleanTechnica's reporting, Abel acknowledged in his letter that rising electricity demand and more frequent wildfires will impact the delivery of affordable and reliable energy to Berkshire's utility customers. He also stated, and I want to quote this accurately, that the CEO is responsible for serving as chief risk officer. Those are his own words. But critics are pointing out a glaring contradiction at the heart of this letter.
The contradiction is this: Abel identifies climate-related impacts, rising demand, more wildfires, as material business challenges. He accepts the role of chief risk officer. And then, according to the analysis, he fails to address the financial risks that fossil fuel exposure poses to Berkshire Hathaway's massive portfolio. This is a company with enormous holdings in energy. Berkshire Hathaway Energy is one of the largest utility operators in the United States. They own stakes in fossil fuel-intensive operations. The financial exposure is not theoretical. It's on the balance sheet.
Let's put some numbers around this for our viewers. Berkshire Hathaway Energy operates utilities across multiple states, serves millions of customers, and has significant investments in coal, natural gas, and other fossil fuel infrastructure. The company also holds major positions in fossil fuel-adjacent companies through its equity portfolio. When Greg Abel talks about wildfires impacting energy delivery, he's talking about events that have already cost Berkshire real money. PacifiCorp, a Berkshire Hathaway Energy subsidiary, has faced billions of dollars in wildfire liability claims in Oregon and other western states.
Billions. Not millions. Billions. PacifiCorp agreed to pay over several $1 billion to settle wildfire claims related to the devastating 2020 Oregon wildfires. And those liabilities are growing, not shrinking, as climate change intensifies fire seasons across the western United States. So when the new CEO writes a letter that acknowledges wildfire risk but doesn't connect it to the underlying driver, fossil fuel combustion and the resulting climate change, that's not just an oversight. That's a deliberate editorial choice with significant implications for how Berkshire communicates risk to its shareholders.
And here's what makes this particularly notable. Warren Buffett built his reputation on rigorous, clear-eyed risk assessment. The Oracle of Omaha was famous for seeing what others missed, for quantifying risks that the market was ignoring, and for communicating candidly with shareholders about both opportunities and threats. For the new CEO's very first letter to essentially sidestep the single largest systemic financial risk of our era, climate change and the energy transition, it signals either a lack of understanding or a very deliberate strategic posture.
And financial analysts are increasingly clear that this is a material risk. The transition away from fossil fuels is accelerating globally. The International Energy Agency, major central banks, and insurance companies have all issued warnings about stranded assets, fossil fuel infrastructure that will lose value as the world decarbonizes. Berkshire Hathaway's coal plants, its natural gas operations, its pipeline investments, these are all exposed to transition risk. If Abel is the chief risk officer, as he says, then the question becomes, why isn't the biggest risk in the room being named?
It's worth noting who the audience for this letter is. Berkshire Hathaway shareholders include some of the most sophisticated institutional investors in the world, alongside hundreds of thousands of retail investors who have bought into the Buffett mythology of prudent, long-term value investing. These shareholders deserve to know how the company is positioned for a world that is demonstrably moving away from fossil fuels, not because of ideology, but because of economics. Solar and wind are now cheaper than new coal and gas plants in most of the world. Electric vehicle adoption is accelerating. Regulatory pressure is mounting in every major market.
And the wildfire point is almost a case study in how climate risk becomes financial risk in real time. Berkshire's own utilities have been directly, materially impacted by climate-driven wildfires. The company has paid out billions in settlements. Insurance costs are rising. Infrastructure hardening requires massive capital expenditure. All of these costs are driven by climate change, which is driven by fossil fuel combustion. The causal chain is not ambiguous. It's established science and it's established financial reality.
Now, some might argue that Abel is simply being pragmatic, that acknowledging climate risk explicitly could expose the company to shareholder lawsuits or regulatory scrutiny. But that argument actually cuts the other way. Securities regulators, including the SEC, have been moving toward requiring more robust climate-related financial disclosures. By not addressing these risks proactively, Abel may actually be increasing Berkshire's legal exposure, not reducing it. If climate-related losses mount and shareholders can point to a letter where the CEO explicitly took on the role of chief risk officer but failed to flag the most significant systemic risk, that's a litigation target.
Let's also talk about the opportunity cost. Berkshire Hathaway is sitting on an extraordinary cash pile, well over $100 billion at last count. The energy transition represents one of the largest investment opportunities in human history. Trillions of dollars will flow into renewable energy, grid modernization, battery storage, and electrification over the coming decades. A CEO who is serious about long-term shareholder value would be articulating a clear vision for how Berkshire captures that opportunity. Instead, what we got in this first letter was an acknowledgement of symptoms without a diagnosis of the disease.
Who wins and who loses here? In the short term, fossil fuel incumbents within Berkshire's portfolio might benefit from the lack of transition pressure. Executives who don't want to rock the boat can take comfort in a CEO who isn't pushing for rapid change. But the losers are shareholders who need honest risk assessment to make informed decisions about their investments. The losers are Berkshire employees and communities who depend on the company's long-term viability. And the losers are the millions of utility customers served by Berkshire Hathaway Energy who will bear the costs of climate impacts that could have been mitigated.
And there's a broader pattern here that's worth naming. Corporate America has largely retreated from climate commitments over the past year. ESG has become a political football. Companies that were making net zero pledges are now quietly walking them back. Greg Abel's letter fits this pattern. It's climate acknowledgement without climate accountability. It says yes, wildfires are a problem without saying, and here's what we're doing about the root cause. That kind of rhetorical half-measure is becoming the default corporate posture, and it should alarm anyone who understands compounding risk.
The power structure behind this is clear. Berkshire Hathaway is one of the most influential companies in the world. What it does, and what it says, sends signals throughout the investment community. If Berkshire's new CEO won't name fossil fuel risk, it gives cover to every other company that wants to avoid the conversation. It normalizes silence on the most important economic transition of our lifetime. That's not neutral. That's a choice with consequences.
Now, Alex, let's bring these two stories together, because on the surface they look unrelated, a Chinese AI drug company hitting profitability and an American conglomerate dodging climate risk. But there's a thread that connects them, and it's this: we are watching, in real time, how different corporate leaders respond to massive structural shifts in the global economy.
That's exactly right. XtalPi represents one response: lean into the disruption. Take the risk. Invest in new technology. Build the platform. Burn cash until the model works, and then prove it out. It took years. They lost enormous amounts of money. But now they're profitable, and they're positioned at the leading edge of a transformation in how humanity discovers medicine. That's what forward-looking corporate leadership looks like.
And Greg Abel's first shareholder letter represents the opposite response: acknowledge the disruption at arm's length, avoid naming its causes, and don't present a clear strategy for navigating it. Berkshire Hathaway is one of the most resource-rich companies on the planet. It has the cash, the talent, and the scale to lead the energy transition. Instead, its new CEO wrote a letter that treats wildfire as a logistics problem rather than a systemic risk requiring strategic transformation.
The pattern across both stories is about corporate courage, or the lack of it. XtalPi's founders bet their careers on the idea that AI could revolutionize drug discovery, and they've now been vindicated by the market. Greg Abel inherited a company that could bet big on the energy transition and signal to the entire investment world that the era of fossil fuel complacency is over. Instead, he punted on his first at-bat.
And these two stories illuminate a global power shift that doesn't get enough attention. China is producing companies like XtalPi that are willing to invest heavily in transformative technology and absorb short-term losses for long-term strategic positioning. Meanwhile, some of America's most iconic companies are struggling to even articulate a vision for the future, let alone invest in one. That asymmetry has consequences for markets, for innovation leadership, and ultimately for which economies thrive in the coming decades.
The common thread is risk. In Shenzhen, XtalPi took enormous financial risk in pursuit of breakthrough technology, and it's paying off. In Omaha, Berkshire Hathaway has a CEO who says he's the chief risk officer but won't name the biggest risk on his books. One company embraced uncertainty to create value. The other is hiding from it to protect the status quo. The market will eventually sort out who was right, but by then the consequences may already be locked in.
And for our viewers, the takeaway is this: pay attention to what corporate leaders do, but pay even closer attention to what they don't say. The silences in a shareholder letter can be more revealing than the text. The risks a CEO refuses to name are often the ones that matter most. And the companies that survive and thrive through periods of disruption are the ones that run toward the future, not away from it.
That's the truth report for tonight. 2 stories, 2 continents, 1 uncomfortable question: are the companies that control our economy being honest with us about where the world is heading?
Based on what we've seen tonight, the answer is mixed at best. Some are leading. Some are hedging. And some are just hoping nobody notices. Our job is to make sure you do notice.
If these stories matter to you, and they should, share this report. Read the source material. The South China Morning Post has the full XtalPi filing details. CleanTechnica has the analysis of Abel's shareholder letter. Do your own research. Follow the money. Ask the questions your financial advisors might not be asking.
For Truth Report, I'm Maya Clarity.
And I'm Alex Truth. We'll see you next time. Stay informed, stay skeptical, and never stop asking who profits from your ignorance. Good night.